Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hua Hong Semiconductor Limited annual report. Hua Hong Semiconductor Limited offers a diverse range of semiconductor products and services to various industries worldwide. The company manufactures and sells embedded non-volatile memory, standalone non-volatile memory, power discrete devices, analog and power management platforms, specialty logic RF processes, and image sensors. In addition to its product offerings, Hua Hong provides design services that cover a wide scope, including design methodologies, design flow support, standard and customized Internet protocol development, ASIC design, and one-stop services. The company also offers multi-project wafer services, mask marking services, back-end testing development, mass production, product engineering, and backside processing services. Furthermore, Hua Hong engages in real estate development and trading activities to diversify its business portfolio. Its products are utilized in various applications such as consumer electronics, industrial control, automotive electronics, Internet of Things, communications, and computers. With a presence in China, North America, Asia, and Europe, Hua Hong Semiconductor Limited has established itself as a significant player in the global semiconductor industry. Hua Hong Semiconductor Limited market capitalization of $182 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Hua Hong Semiconductor Limited holds a significant advantage in their industry. Hua Hong Semiconductor Limited trades at a higher price-to-earnings ratio of 368 times and a higher price-to-book ratio of 3.09 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 28% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the growth side, several factors contributed to the increase in revenue. The rapid development of artificial intelligence and edge applications, as well as the fast growth in high-performance computing chip and memory chip markets, were key drivers. Additionally, the steady recovery in the mature process chip market and the swift increase in revenue contribution from 12-inch wafers due to capacity ramp-up of Hua Hong Manufacturing Project, FAB9, also played a significant role. Furthermore, satisfactory results across major specialty technology platforms, such as analog and power management, embedded non-volatile memory, and standalone non-volatile memory, contributed to the revenue growth. The demand for these platforms in various end markets, including consumer electronics, automotive electronics, and energy solutions, also drove revenue growth. Other factors that contributed to revenue growth include increased wafer shipments, improved average selling price, cost reduction efforts, and growing demand for chips in various industries. On the decline side, there were fewer drivers mentioned. The only notable decline was in Europe, with a 2.6% year-on-year decrease. Additionally, sales to related parties, such as Hua Hong Zielkor and Hongri, decreased compared to the previous year. Overall, the revenue growth drivers far outweighed the decline drivers, resulting in a positive revenue growth rate of 0.8%-2%. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it decreased from $58.1 million in 2023 to $54.9 million in 2024, indicating a decline of $3.2 million. However, the following year saw an increase of $16.1 million, bringing the net income to $0.034 billion in 2025. The profit margins also experienced changes during this period. In 2023, the company's profit margin was 18%, but it decreased to 11.8% in 2024, a decline of 6.2%. The subsequent year saw an increase of 0.2%, with the profit margin rising to 12% in 2025. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided summary, the net cash flows generated from operating activities have shown a significant increase of 41.5% compared to the previous year, reaching $649,992. This upward trend is consistently reflected across multiple pages in the report, further solidifying the company's financial stability and growth. The positive operating cash flow indicates that the company is efficiently managing its resources, generating sufficient revenue to cover its expenses, and investing in future growth initiatives. The company's debt level has undergone significant changes over time. Initially, total current liabilities increased by 19.3% from $1,562,238 to $1,856,221. However, interest-bearing bank borrowings saw a substantial decrease from $2.79 billion to $26 million. On the other hand, long-term payables increased significantly from $0 in 2024 to $594,581. Furthermore, total debt has risen by 45% from $2,197,939 to $3,190,844, with interest-bearing bank borrowings increasing by a substantial $992,905,000. In contrast, the company's interest expenses have shown mixed results. In some instances, they decreased slightly or remained unchanged. For example, interest expenses decreased by $26,056 from $105,736 to $79,680, and total finance costs decreased by $28,899 from $97,113 to $68,214. However, in other cases, interest expense remained relatively stable, such as the 8.2% decrease from $887,000 to $815,000. Overall, while the company's debt level has increased significantly, its interest expenses have decreased slightly or remained unchanged in some instances. This suggests that the company may be managing its debt effectively and reducing its financial obligations. The performance of various segments and regions was a mixed bag in the given period. On the positive side, the Chinese mainland and Hong Kong saw a significant increase in revenue, jumping from $1,636,528 in 2024 to $1,974,098 in 2025. This growth was also reflected in Asia, excluding China, where revenue rose slightly from $110,038 in 2024 to $114,151 in 2025. However, not all regions fared as well. North America experienced a decline in revenue, dropping from $187,899 in 2024 to $246,091 in 2025. Europe also saw a decrease in revenue, falling from $69,528 in 2024 to $67,724 in 2025. These results indicate that some regions struggled to match the growth seen in other areas, highlighting potential challenges and opportunities for improvement. Management is optimistic about the company's outlook, highlighting several key initiatives and strategies that will drive growth and success. In the short term, management aims to complete various projects by the end of 2026, including the Hua Hong Manufacturing Project and the Specialty Technological Innovation Project. These efforts are expected to upgrade and modernize the company's production lines, leading to increased efficiency and competitiveness. In terms of long-term strategy, management is focused on innovation-driven growth, talent development, and cohesive workforce engagement. This includes building a knowledge-based industrial workforce through a systematic talent development system, fostering a positive work environment, and enhancing corporate governance. By prioritizing these areas, the company aims to establish itself as a leader in its industry. The company also has a strong commitment to environmental, social, and governance (ESG) principles. Management is focused on identified ESG material topics with high influence and financial importance, including climate-friendly technologies and eco-friendly products. This includes prioritizing investments in these areas and improving water resources management systems to enhance efficiency and reduce operational costs. Furthermore, management emphasizes the importance of employee well-being and development, with initiatives such as establishing a rapid response mechanism for employee appeals and promoting comprehensive supporting projects for employees' practical needs. Finally, the company aims to set industry benchmarks through its academician workstation, focusing on technological innovation and upgrading, particularly in memory technology. The company's dividend and share buyback activities over the past 2 years are worth noting. In the year ended 31 December 2024, the company paid out $36,247 in dividends to its shareholders. However, this trend did not continue into the following year, as no dividends were paid out in the year ended 31 December 2025. On the other hand, the company has been actively buying back shares from the market. In both years, the company's share buyback activities resulted in a net decrease in its outstanding shares. Specifically, in the year ended 31 December 2024, the company bought back $1,215 worth of shares, while in the year ended 31 December 2025, it bought back $11,446 worth of shares. Concerns about inventory buildup and supply chain disruption are evident in the company's operations. On page 83, sustainable supply chain management is highlighted as a topic with double materiality, indicating its importance in both financial and non-financial aspects. This emphasis on sustainability suggests that the company is aware of the potential risks associated with supply chain instability. Furthermore, page 88 notes the risk of supply chain instability and its potential impact on profitability and competitive advantage. The company's decision to diversify suppliers and meet environmental and social responsibility standards may be contributing factors to this risk. This indicates a need for careful management to mitigate these effects. The data on inventory levels from page 388 paints a concerning picture. Raw materials, work in progress, and finished goods have all seen significant increases, with finished goods rising by a staggering 90.6% from 2024 to 2025. These numbers suggest that the company may be experiencing issues related to inventory buildup or supply chain disruption. That concludes the financial summary for Hua Hong Semiconductor Limited. Feel free to comment below, and I will be happy to answer them when possible.